Raj, thank you so much for joining in. Thank you so much for taking the time. I want to start by asking you, when it comes to the equity markets at these levels, should one consider on an ongoing basis shuffling the pack as far as their portfolio is concerned? If, say, you had a 60-40 ratio that you started out with, it's quite likely that that ratio is now skewed very heavily in favor of equity. How often should you rebalance?
Thank you, Alex. So kind that you invited me to the show. I'm honored. Now, before you give into the market noise, just take a step back and look at how the 60,000 milestone for the Sensex has changed things for you. Have your financial goals changed? Nope. Have the required amount of these goals changed? No. Has your risk appetite changed? Possibly. So while two critical factors, namely goals and requirements, have not changed, a 200-odd point movement in the Sensex from its Thursday close of 59 and 800 something has changed your appetite for risk and is pushing you to rejig your investment portfolio. This is something that investors need to contemplate before they press the sell button. So if your goals and your requirements have not changed, your investments should also not change. Do not lose sight of your financial goals. And while I say this, I talk about individual, investors, not institutional investors. So at the same time, the 60,000 peak is a good time to book partial profits, especially in certain overpriced stocks. Some stocks are trading at P multiples of more than 70, 80 times their EPS. And you could certainly consider selling them off. But two things. You should take into account your overall asset allocation. Investors should rebalance their portfolios, which is, Alex, what you were referring to, and restore the pre-decided asset allocation. Don't make a drastic change in your pre-decided asset allocation. See, research shows that investors who periodically rebalance their portfolios may not earn the highest return in a given year, but in the long term, they earn the best returns. And when we are talking about booking partial profits, it's also always de rigueur, as you might say, to mention that keep an eye on the tax, because there is obviously a fair bit of difference between long-term capital gains tax and the short-term variety. So do keep in mind all of these, or the tax implications of whatever you intend to sell.
Okay. Now you make excellent points, Rajan. I think it's a great time to talk about one particular aspect. From what I took from what you were saying, your goals haven't changed, your financial goals haven't changed, and I would think that the thumb rule generally would be that if you have a relatively short-term goal between 2 to 3 years, you would normally go towards a debt instrument or an interest rate of an instrument that gives you a fixed rate of return, right? And if you have a relatively longer term goal, which is above 5 years, you choose to go towards something like an equity, which gives you more growth over a longer period of time. But my question to you is, do you have then, and there's a third way of doing it, which some financial planners, Raj, talk about, is that each of your goals can have a very small percentage of whatever, debt or equity, depending on the duration of your goal. So then do you have an overall portfolio-based allocation towards debt and equity, which you identify based on your risk profile, or do you go about it in the way that I was talking about, which is each goal has a separate allocation?
Well, you see, each goal has a separate allocation. You could look at it that way, as you described, Alex. But that all of this depends. There's a basic concept of materiality, as in what is the total sum that we are talking about. If it is a lot, and a lot is defined differently for different people. But if it is a huge amount that you're actually going to be investing in achieving these goals, then yes, you could customize your allocations and so on. But if it isn't as substantial as it might be, then it's probably better to go with an overall asset allocation ratio. I might add a little bit further to what you said in terms of if it's 4 to 5 years, then you could go with debt. And if it's 7 years away, you could go probably with equity. It would probably help you reach there most comfortably. There's also the usual 50-50 mix or something in the between 5 and 7 years away. So, and As far as rebalancing is concerned, should be at the portfolio level, and the asset allocation must be decided by taking into account your overall portfolio, and then the rebalancing should be done. The exercise must take a holistic view of the portfolio, otherwise it will not yield desired results.
Raj, quite a few people would have had that niggling feeling as the equity benchmarks kept soaring, waiting for that correction, thinking that the correction is imminent, and then periodically taking some money out. If they had felt that they're doing this rebalancing, they could at least ease their conscience to a certain extent when the Nifty 50 is at close to 18,000 now, thinking that they're doing something that is predetermined. Okay, so that's one aspect. But assuming that somebody has missed out on the rally, has been waiting for that long-awaited correction, thinking I will put in at this point, what advice would you give to those people?
Well, first of all, the homilies, which is experts normally say that you should buy when they sigh and sell when they yell. In other words, one should buy when markets are low and sell when they are high. Big deal, everyone knows that. Unfortunately, many retail investors do exactly the opposite, which is what brings me to answering the question you asked. The 60K level of the Sensex certainly looks intimidating for those who sat out during the rally. At the same time, there are pockets of underperformance in the market that still offer value. I mean, I don't normally talk about specific shares, but the theory of a mean revision says that these underperformer stocks will ultimately catch up. They like a rising tide will lift all boats, it'll lift these boats too. So even though I don't usually take names of individual stocks, but it would be a good idea to explore certain defensive sectors like FMCG, ITC is a value pick, or power, NTPC, Tata Power, Power Finance Corporation. How about oil and gas, which is GAIL and Mahanagar Gas? But this is where the SIP advantage comes to the aid of mutual fund investors. By staggering their investments in monthly installments, they diversify their exposure. If markets go down from here, they will be able to buy more at low prices. If markets continue to do well, their investments will gain. Either way, they stand to gain. So my advice would be to take the SIP route and earn stable returns for your stock investments. I might also add that this is a good time for investors to diversify their portfolio with an international exposure. Global exposure is no longer a fad, but a very good way to diversify the geographical risk. And that will also open the blinkers a little bit. So US markets have delivered good returns, and I personally think will continue to do so. So if you are selling some Indian stocks, consider buying some US-focused mutual funds or ETFs. I think that would be a good way, to look at the present situation in terms of if you had missed the rally, what are the things to do? There are pockets of underperformance even today. If you look hard enough, you'll find them, and also look internationally.
Absolutely. Raj, one of the factors that has differentiated this rally in the equity markets compared with what we've seen in the past several years is a kind of immense participation from retail investors. We've seen the number of demat accounts absolutely grow by a staggering amount, and more individuals getting into the market. There is one statistic that pointed out that if you look at the average traded volume on the National Stock Exchange in this financial year, about 45% of the daily volume is accounted for by retail investors. Well, I shouldn't necessarily call them retail investors because there's a fair number of traders in there as well. Is it important, according to you, and in the advice that you give young people also getting into the market, is that you need to draw the line and you need to talk about how trading is an entirely different beast from investing? And you spoke very specifically about SIP approach, investing in individual stocks. And that, according to me, means that you should hold for a pretty long period of time. So if you are to do trading, do you then carve out a small portion of your equity portfolio and your equity allocation and then do that? How do you go about it?
Yes, you see, you could first of all, it is always prudent to carve out, a portion of your entire portfolio and allocate that towards trading. But a word of caution here, especially since we are talking about retail investors, individual investors, which you quite rightly pointed out is a high volume, in recent times. I have to add that a quintessential retail investor, someone who has a regular job or a regular business, and all of his mind space is taken up by, that item, should essentially try to stay away from day trading. So when we talk about taking a small portion and putting it away towards trading and then trading that and trying to make money out of that, that should be applicable for those people who can actually spare the time. Because it does seem attractive to be able to say that, I've secured a portion on this side, and now, I've carved out a part of my equity portfolio with which I do trading. Sure, by all means, that is the way to do it. You should never do trading with all of your money and with all of your investments, but only do, even with part of your investments, only I would tell the youngsters, only do so if you're able to spare quality time on a daily basis. Otherwise, you'll end up losing this as well, because it's all a function of time.
Absolutely. I do want to touch base a little bit more and perhaps to the end of this conversation and I want to take this opportunity. You spoke about diversification and you spoke about perhaps looking at some of these international funds. Would it be possible for you to give us a few ideas as to where investors can look, a list of maybe 3 or 4 options that they can consider?
You see, this is a subject, Alex, I'd rather not go into specifics, but I can certainly point them in the right direction. First and foremost, take professional advice, because, this is not something that you can read in the newspapers on a day-to-day basis. So do take professional advice, before you start walking down this road, and continue to consult somebody professionally as you go along. But yes, having said that, I might add that, the best way to do this is to look for those ETFs, which are quoted regularly on NASDAQ or on the NYSE, and see the ones that at least, you have some knowledge of. Try not to go for something which is completely foreign to your mind space, because even if it is overseas, it is far away, but it does help if you always have some background of the industry or the industries or the basket, that if it's an ETF or the basket that you're going for on an international basis. These are available on the internet, and you can actually access them quite easily. And like I said, if you spoke to a professional advisor, he would certainly be able to line that up for you. It's quite easy. It's only that I don't want to get into the specifics of international investing.
I completely understand. And Raj, you've been incredibly, you've conveyed your thoughts very well, I must say that, and appreciate the time that you spent with us. Thank you so much for taking the time.
Thank you, Alex. Pleasure being with you.